So one of the questions that I keep getting asked is whether we've already passed the bottom of this 2020 stock market crash or if we're headed for new lows sometime this year. And part of the reason why I keep getting asked this is because the Fed has recently announced trillions of dollars in new loans and different policy measures that they're implementing to basically ensure that much fewer companies are allowed to go bankrupt during this current economic crisis. Well, in today's video, I'm going to explain why the bears think that we are headed for new lows, basically a bigger crash coming this year. I'll give you the reasons why the bulls think that we've already bottomed out last month, thanks in part to what both Washington and the Fed are currently doing to keep the economy from collapsing. And then I'll finish up by giving my personal opinion on all of this and making a prediction. By the way, as a long-term investor, I'm not someone who believes in timing the market, but if you guys want me to give a prediction on what I think is going to happen, I'll do that for you guys. And I'll also let you know what I'm personally doing myself to kind of get through this time period and move forward past it. But I hope you guys enjoy the video. And if you do, make sure you hit the like button. It really helps the channel. It's free and it means a lot to me. But with all that said, let's go ahead and start on the more pessimistic side of things. And we'll take a look at how the stock market has rallied recently. And we'll make the argument for it being too overly optimistic right now and why we might be headed right back down to new lows. Okay, so here's a chart of the Dow Jones over the past 3 months, and you can see that nasty crash there of almost 40%, which, by the way, was one of the sharpest crashes in history, yet it still wasn't good enough for a lot of short-term trading fortune tellers that believe they can perfectly time the market. And at that time, a lot of people were screaming that there was no chance that the market could climb higher from those lows, and yet here we are today, and the market actually soared by over 30% at one point and is still up today by over 28% from those lows. Still, there's plenty of reasons to think that heading right back down there to the bottom is a very real possibility. First of all, this now puts us close to the midpoint of our 52-week range and around the same levels that we were at just about a year ago, which seems way too optimistic to me given that the economy is clearly in much worse shape. And while this may look like a V-shaped recovery in the stock market, there's no way that we're experiencing a V-shaped recovery in the economy given how badly everything has escalated. Now, YouTube doesn't let me talk about that global issue that is disrupting everything, but I'll just quickly mention that US cases have continued to climb right along with the rest of the world as well. And while there are new reports coming out talking about a possible peak happening sometime soon, daily increases remain on the high end, so it's very possible that the market is pricing in a much more optimistic situation than the reality that we are living in, but I guess time will tell. Regardless though, the economy is clearly being destroyed because of government enforced shutdowns that will likely last until May at the very least. And even if we do open up by then, I still don't think that it's going to be like a flip of a switch and the entire economy opens all at once. What's much more likely is that we implement different kinds of measures to ensure that we keep control over that global issue. So I could see opening up slowly, gradually, maybe certain places, certain businesses, certain people, doing it kind of that way, and all the meanwhile you're still building up your medical supplies, you're understanding this global issue better, you're hopefully building up immunities to it, and gradually we start to get back to normal, and eventually you also release a shot which really drastically improves the entire situation. But that's still going to take time, and the more that this shutdown continues, or even if you start to open up the economy slowly, you're talking about one of the deepest recessions that we've ever seen. And currently there's plenty of signs suggesting that the economy is getting absolutely destroyed, and yet it feels like the market is dismissing a lot of that. In fact, we've now seen the largest spike in unemployment claims in history, and it's not even close. In just the past 3 weeks, we've seen almost 17 million people file for unemployment. To give you an idea of how massive that is, here's a chart of unemployment claims throughout several decades, and you can see that absolutely gigantic spike at the end there that just looks completely out of place compared to the rest of it. Now, zooming in here, this is the last 3 weeks, and unemployment claims surged to a record 3.3 million, then more than doubled that record at nearly 6.9 million, and even then only slightly came down to 6.6 million. So that's really incredible, like what we're seeing here. And it's the reason why such drastic actions are being taken to combat that, but we'll talk more about that in just a second. In any case, these horrific numbers have led to JP Morgan now predicting 25 million jobs lost in April, with unemployment reaching 20% and GDP declining by an absolutely massive 40% in the second quarter. These are depression-like numbers, and yet again, the stock market has done nothing but climb in recent weeks, which is pretty shocking. In fact, there has never been a time throughout all of our history that a bottom was reached this quickly. Here's a chart I created for you guys showing S&P 500 bear market since World War II, and you can see that the average bear market in white there lasted over 360 days. Our bear market here in 2020 on there in yellow, it only lasted 33 days. That's insanely lower. And by the way, this chart is using the strict rules of a bear market ending as soon as a bull market starts. So you see that 62-day bear market there for the '09 year during the Great Recession. The only reason that bear market is so small is because there was a super short and very small bull market that broke it off of the bear market that started in '07. But that bull market only lasted a couple months. So if you take it away, that really small bear market of 62 days, it would actually be 470 days in total, and it would also bring up the average. And that begs the question of whether we could be seeing something similar here in 2020 with our current bull market. Perhaps it's just a short rally within the bigger bear market like it was during the last recession. Definitely something to think about. Okay, now on top of that, you also have to remember that we haven't even seen what kind of damage is going to be done to company earnings yet. Now, this isn't a perfect correlation, but as you see on this chart of the S&P 500 compared with company earnings, the market follows those earnings fairly closely. Now, this chart only goes up to the start of this year, but obviously we're very likely to see earnings crash throughout this year, especially in the second quarter where, again, according to JP Morgan, the US economy could drop by 40% and unemployment rise to 20%. So what is that going to mean for corporate earnings? Keep in mind that almost 3/4 of GDP is consumer spending. So what's going to happen when all of a sudden people don't have jobs? And even though those that do are seeing nothing but horrifying headlines from the media every single day. The likely outcome is that people will cut down on spending, especially on anything that isn't absolutely essential. So while some companies like Amazon with online shopping or grocery stores like Walmart or big cloud players like Microsoft might all do just fine, others will get crushed. As a result, FactSet is expecting S&P 500 EPS growth to fall by 10% in Q1, plummet a lot more by 20% in Q2, continue the negative growth trend in Q3 at almost another 10%, and then get close to breaking even again in Q4, but still fall by about 1%. And to be honest, I actually feel that these estimates are too optimistic. A Q1 drop of only 10% is understandable because we were barely starting to close down the economy at the end of it, and before that nobody was really taking that global issue that seriously, so spending was likely still high from people with jobs that were living their normal lives as usual. But today though, here in the second quarter, the story is the complete opposite. People are losing jobs, businesses are trying desperately to survive, and other than buying groceries at Costco or ordering through Amazon, I'm just not sure what you'd be spending money on when all of these businesses are shut down as well. So for Q2 earnings to only drop by 20% on average, that seems a little low to me. Keep in mind that share buybacks will also likely be non-existent because not only does a lot of that new stimulus from the government restrict share buybacks for possibly years to come, but at the same time, Standard & Poor's is predicting that because of the macroeconomy, companies are trying to desperately save cash and ensure liquidity, and that will likely result in what they call dismal Q2 share buybacks that will likely continue to be slow even after the stock market bottoms, which will take a nasty toll on those EPS numbers. Keep in mind, there's still the risk that the shutdown gets extended or even a second wave of that global issue even after we open things back up. So what happens in those scenarios? What happens to the gyms and the malls and the restaurants and the theaters and the theme parks and travel and so on? I think these are things that you have to be conscious of. All the meanwhile, we are likely in a very deep recession. So I just think those drops in Q2 and Q3 might be a little optimistic. I think Q4 makes more sense from a recovery standpoint, but even then, I think there's a chance that we miss estimates and surprise to the downside. So again, in my opinion, I think it's looking more likely that we'll see the majority of the recovery take place in 2021, and that could resemble something that looks more of like a U-shaped recovery. Yet, when you look at the stock market, it feels like it's pricing in something that resembles more of a V-shaped recovery, which doesn't make a lot of sense when you consider all of the things that we've already discussed in this video so far. Now, having said all of that, what are the bullish arguments for the stock market? What are the arguments for the stock market having already bottomed? And what are the things that the government and the Fed are doing to keep the economy from collapsing? Well, let's go ahead and take a look at those bullish viewpoints right now before wrapping everything up with my predictions and what I'm doing myself. Now, what's been causing the market to rally? Well, for starters, the Fed has lowered rates down to zero, making it easier to borrow and spend, which helps keep money flowing throughout the economy. On top of that, Trump signed a record-breaking $2 trillion stimulus package passed by Congress in late March that is not only giving direct payments to Americans to help with their finances, but has also strengthened unemployment insurance while also providing loans for businesses on condition that they don't lay off employees to also help with those really high unemployment rates. On top of that, the Fed has essentially guaranteed that many companies can't go under by mostly creating trillions of dollars that they intend to use to provide more loans to both companies and also local governments that need it and buy up business debt and bonds, even if they are in junk status, as long as they were downgraded in March because of everything that's happened. So basically, anything that was at risk of failing, the Fed is now saying, hey, we'll help you get through this time period and provide as much liquidity as you need so that we can kind of get through this and return to normal business after when the economy opens back up. And of course, many people hate this because the effect of limitless quantitative easing, like printing money and buying debt, has already ballooned the Fed's balance sheet to a record high of over $6 trillion, which completely eclipses even what we saw during the Great Recession, as you can see on this chart here. And they worry that this can lead to a lot of inflation while also allowing bad companies with bad management or bad balance sheets to survive by bailing them out, when conversely, they should be allowed to fail so that better companies can emerge and ideally avoid making those same mistakes in the future. On the other hand, others would argue that it's none of these companies' faults to begin with, and if you let them go under, then we could see even more horrific unemployment numbers, the entire economy will collapse, and many lives will be devastated. So let me know which side of the argument you guys agree with more and your reasons why down below, but I'll share my personal thoughts on that in just 1 second. Now, having said that, that's basically how the stock market is looking at this, as moves that will ensure that these companies survive over the long term. So it's trying to trade based off of that, because the market tries to be forward looking and trade based off of what's going to happen in the future rather than what's happening right now. In fact, if you look back at the Great Recession, here's a combo chart that shows all the stocks on the New York Stock Exchange and when they hit bottoms there on the top, and then on the bottom you have the S&P 500 index. And you can see that most stocks actually hit bottoms in October of 2008, and the S&P 500 index hit its lows on March of 2009. Yet the economy itself didn't start expanding until July, and the unemployment rate didn't even peak until October of that year. So in some ways, the market had bottomed out a full year before unemployment had even peaked. And obviously a peak in unemployment is still, a very ugly environment where everyone thinks that the world is going to end, and perma bears are calling the stock market a scam and are calling anyone an idiot who is buying stocks. Yet those so-called idiots were actually riding a rally by then, and all the perma-bear short-term traders didn't even realize it. Also, I don't take this next point too seriously, but it should be noted that market sell-offs don't last as long as they typically do when they are event-driven rather than caused by deep economic fundamentals. So here's a chart from Statista showing that bear markets caused by structural problems or by cyclicality both last longer and also take longer to fully recover from than event-driven bear markets, which is exactly what this is. This is an event-driven downturn caused by that global issue and how we are responding to it by forcing the economy to completely shut down. And finally, I'll just add that there's also been progress made in the energy markets, as Saudi Arabia and Russia, along with several other countries, are finally agreeing to some oil cuts that will, ideally help stabilize some of those oil prices, which are currently being battered by a drop in travel demand. But putting it all together, what are my personal predictions and what am I doing myself? Well, I personally think that there's too much action being taken by the government and the Fed for the stock market to really retest those lows. Well, let me put it this way, to go lower than those lows. So say 17,000, 16,000, 15,000 on the Dow Jones. I don't think that's very likely because there's too much stimulus and policy making taking place by, again, the government and the Fed. Now, having said that, I personally do think that the actions being taken are necessary, because I think that things would be a lot worse if they didn't implement these policies. And I know that that's very controversial. I know that there's a lot of ways you could argue both sides. It's just my opinion. I personally think that we do need it, because if we didn't do these things, then I think a lot of lives would be devastated, and I'd rather not see that happen. Again, just my opinion. Now, having said that, I do also think that we are being too overly optimistic at this point, because when I look at that global issue, it does not look under control to me. And when I look at the economy, it's paying a huge price for everything that's going on. And for the market to be rallying the way it is, it just doesn't make a lot of sense to me. So I do think we're being too overly optimistic, and we're pricing in too much optimism, because when you look at the full year, EPS estimates from FactSet for the full year, it's only expected to drop by less than 9%, with revenue being almost flat. And look, maybe I'm wrong about this, but that just seems way too optimistic to me given everything that's going on right now. So I think we could be setting ourselves up for some disappointments. And if so, I think it's a very real possibility that something like the Dow Jones ends up falling a few thousand points from here. Now, again, this is just my gut opinion prediction. If you really force me to make one, I'm a long-term investor. I don't normally do this, so take it for what you will. It's just my random thoughts. But I will continue to focus on long-term investing. If I like a stock at a certain price, I will buy that stock. But at the same time, I will also keep cash on the sidelines, because I do think that these next couple months will be incredibly volatile. I think we could see some great prices moving forward. So why not play kind of both sides of the coin there? So anyway, those are just my random thoughts. Let me know what you guys think and have to say down below. I would love to read those comments and hear all your different opinions. Anyway, thanks again for watching. Thank you for all the support. It means the world to me. Stay safe out there. I'll catch you guys in the next one. Take care. Bye-bye.